It begins with a screen full of red. Silver is down 8% on the day, candles collapsing on the chart, social media feeds filled with words like meltdown and liquidity crisis. At first glance, it looks like chaos, random selling, panicked traders, and some mysterious force hammering the price. But markets rarely move that violently without a very specific chain reaction taking place under the surface. When you see a move that sharp in a major globally traded asset like silver, you're not just looking at investors changing their mind. You're watching the plumbing of the financial system flex, strain, and in some places temporarily break. To understand what just happened, you have to step away from the price line and ask a different question. Not why is silver down, but why did the selling suddenly become so much more urgent than the buying? That's a question about liquidity, not about long-term value. Liquidity is the ability to trade size, large amounts, without moving the price too much. In normal times, silver is highly liquid. It trades on major futures exchanges through large ETFs, via over-the-counter contracts, and in physical form. On a typical day, billions of dollars worth of silver exposure change hands quietly, with prices ticking up and down by fractions of a percent. An 8% intraday move is a sign that something severe has disrupted that balancing mechanism. Silver is a strange hybrid asset. It's partly an industrial metal used in electronics, solar panels, and medical applications, and partly a monetary or store of value asset that investors buy when they worried about inflation, currency debasement, or systemic risk. That dual nature means that silver sits at the intersection of industrial demand, macroeconomic expectations, and speculative trading. It's also heavily traded in leveraged form through futures, options, and margin accounts. Leverage is the quiet accelerant behind almost every dramatic market move. It allows traders to control a large position with a relatively small amount of capital. That works beautifully when prices move your way. It becomes brutal when they move sharply against you. On the day silver drops 8%, the visible story people tell is usually something like this: a strong dollar, rising interest rates, or disappointing economic data hit sentiment. Investors flee risk assets. Silver gets dumped. There may be truth in that narrative, but it's incomplete. Macro headlines are often just the spark. The fire that follows is driven by positioning and liquidity. Who was long silver? How leveraged were they? What were their margin terms? How much risk were the banks and brokers carrying against them? The answers to those questions determine whether a 2% move becomes an 8% cascade. After any big move, you'll hear talk of forced liquidations and margin calls. Those phrases are not just drama, they're mechanics. When silver futures are trading on margin, an 8% downside move can wipe out a substantial portion of the equity that traders have put up. Once their losses breach certain thresholds, brokers and clearinghouses automatically demand more collateral or start selling out positions to protect themselves. That selling, in turn, pushes prices even lower, triggering more margin calls for other traders. This feedback loop turns what might have been a manageable decline into a free fall. At the same time, liquidity providers, the market makers who constantly post buy and sell quotes, start to step back. Their job is to stand in the middle, taking the other side of customer trades and managing their own risk. But they're not in the business of catching falling knives. As volatility explodes and order flow becomes one-sided, they widen their bid-ask spreads, reduce the size they're willing to take, or in extreme cases, temporarily pull quotes altogether. Now the market's depth thins out. Every new sell order has to hit a smaller pool of resting bids, causing larger price gaps. It looks like panic, but what you're really watching is the market's liquidity evaporate in real time. Meanwhile, outside the futures pit, silver ETFs, which many retail and institutional investors use as an easy way to gain exposure, are being hit with massive sell orders too. Authorized participants, the firms that arbitrage between the ETF and the underlying silver or futures, have to redeem shares, sell futures, and adjust hedges. Their hedging flows add to the selling pressure in the derivatives market. A move that may have started in one venue quickly propagates across the entire ecosystem of silver exposure, from derivatives to ETFs to over-the-counter contracts. This is why an 8% drop in silver is much more than a line on a screen. It's a symptom of stress in the system that finances silver positions and intermediates silver trades. When people start calling it a liquidity crisis, they're pointing, sometimes loosely and sometimes accurately, at the possibility that the stress has spilled over from just the silver market into the broader machinery of leverage and funding. The critical question becomes, are we looking at localized turbulence, or is this the first visible crack in a much broader structure? That's where the explanation deepens. Because behind the pure price action, screens turned red, traders shouting, algorithms dumping, is a quieter, more consequential battlefield, the world of margins, collateral, and funding lines. And to see why a single metal dropping 8% can matter far beyond commodity investors, you have to step into that world. Now we move into the second part of this explanation, where the drama shifts from the trading floor to the balance sheets of the people who are holding silver and the institutions financing them. When you hear liquidity crisis, there are really two related concepts at play: market liquidity and funding liquidity. Market liquidity is about how easy it is to buy or sell an asset without moving its price too much. Funding liquidity is about how easy it is for traders and institutions to borrow money, roll their debts, and meet margin and collateral calls. Those two kinds of liquidity are tightly connected, and when one breaks, the other often follows. Leverage is the bridge between them. Consider a hedge fund that has built a large long position in silver futures using borrowed money. The fund posts a margin deposit, say 10% of the notional value, and finances the rest indirectly through its prime broker, who in turn is financed by short-term borrowing in money markets and repo markets. As long as silver prices drift higher or remain stable, everyone is happy. The fund earns outsized returns on its capital, the broker earns fees and interest, and the funding markets hum quietly in the background, rolling overnight in short-term loans. Now inject an 8% single-day price drop. On paper, the notional value of that silver exposure has plummeted. For a leveraged fund, an 8% move in the underlying might translate into a 40%, 60%, or even 100% hit to their equity in the position, depending on how aggressively they were levered. The clearinghouse recalculates margin requirements and issues a variation margin call. Post more collateral by the end of the day, or we will liquidate your position. The prime broker, seeing the mark-to-market losses, may tighten risk limits or demand additional collateral as well. What was, in normal times, a steady river of cheap funding suddenly becomes a narrow, fast-moving stream with sharp rocks. The fund now faces a brutal choice. If it has spare cash or other assets it can quickly pledge as collateral, it might top up the margin and ride out the storm. But often these funds are fully invested. Their liquidity is tied up in other positions that may themselves be under stress. To meet the margin call in silver, they may have to sell something else: stocks, bonds, other commodities, even if those markets are not yet under the same pressure. This is how a shock in one asset class spreads to others. Leverage forces investors to sell what they can, not necessarily what they want to. This is the first layer of a liquidity crisis. People needing cash in a hurry because prices moved against them, and their lenders want more collateral. That's funding liquidity stress. But now zoom out one more level. The prime broker that lent them the money is also managing its own balance sheet. It may have financed the fund S silver position via repo, borrowing cash overnight against some form of collateral, possibly even the very silver futures or associated securities. When volatility spikes and asset prices become less predictable, the broker's own lenders may start to haircut that collateral more heavily, meaning they're willing to lend less against the same assets. Suddenly, the broker itself is feeling squeezed. Clients need more financing to meet margin calls, but the broker's own funding sources are tightening. The rational response for the broker is to reduce risk, cut credit lines, shrink balance sheet usage, unwind exposures, and demand better collateral. To the outside world, this looks like credit drying up or banks pulling back. Inside the system, it's simply survival. Every participant is trying to reduce the chance that the next wave of volatility puts them under. At the same time, clearinghouses and exchanges may respond to the spike in volatility by raising margin requirements across the board. From their perspective, they're protecting the integrity of the system. Greater price swings mean greater potential losses, which require more collateral to guard against counterparty default. From the trader's perspective, this is gasoline on the fire. Suddenly, it's not just losing positions that require more cash. Even unchanged or mildly profitable positions demand additional margin because the rules of the game just tightened. This cascading demand for cash and high-quality collateral is what people intuitively sense when they say there is no liquidity. What they really mean is lots of assets are for sale. Very few balance sheets are willing to absorb them, and the cost of keeping positions financed is jumping higher by the hour. In such an environment, even fundamentally sound trades get cut because survival beats conviction. The selling becomes indiscriminate. Notice how little of this is about the story of silver itself. The underlying industrial demand for silver, the long-term inflation outlook, the mining supply pipeline, these fundamentals didn't suddenly move 8% in a day. What changed was the financial structure built on top of those fundamentals. Leverage turned a price move into a cash crisis. Margin frameworks turned volatility into forced deleveraging. Funding markets, sensing elevated risk, tightened their grip. This is why a seemingly technical issue like margin calls can have such outsized impact. It changes the behavior of market participants from willing buyers and sellers expressing views into forced actors scrambling to meet the next cash call. Prices stop being simply information about value. They become a weapon and a warning. Each new downtick erodes collateral values, pushes more players to the edge, and raises the question, who's next? In the background, risk managers, treasury desks, and central banks watch these moves with intense focus because they know how quickly a localized funding crunch can evolve into a system-wide liquidity crisis. And that takes us into the third layer of the story, the broader macro and monetary backdrop that can turn a violent move in silver into a signal of something much larger brewing. Now we enter the third part of the explanation, where silver's 8% plunge is no longer just about commodities or leveraged traders, but about the macro environment that sets the conditions for liquidity crises in the first place. Market crashes and liquidity panics don't happen in a vacuum. They occur within a particular monetary and economic regime. Think about interest rates, central bank balance sheets, bank regulations, and risk appetite as the climate, and the silver market as just one weather system inside that climate. Some climates are humid and prone to storms, others are dry and stable. The macro backdrop determines whether an 8% drop in silver is a passing squall or the leading edge of a much larger storm front. Consider a world of ultra-low interest rates and abundant central bank liquidity, like the decade after the global financial crisis. In that world, funding is cheap, leverage is easy to obtain, investors are pushed further out on the risk curve in search of yield. In such an environment, a sharp move in a single asset can still trigger margin calls and local stress. But it's more likely that someone, another fund, a bank, a proprietary trading desk, steps in to buy the dip. Why? Because they have access to cheap funding, and their confidence that central banks will backstop systemic risk is high. The system is elastic. Now compare that to a world of rising interest rates, shrinking central bank balance sheets, quantitative tightening, and regulatory pressure on banks to hold more capital and less trading risk. In that world, cash is more expensive, balance sheets are scarcer, and lenders are more cautious. When volatility spikes and assets sell off, there are fewer natural buyers with both the willingness and the capacity to absorb risk. Bank dealers have less room to take large positions onto their balance sheets. Hedge funds may already be highly levered in other trades. The system is taut. In a taut system, shocks propagate differently. Rising interest rates have two effects that matter here. First, they increase the opportunity cost of holding non-yielding assets like silver. That puts fundamental downward pressure on prices over time, as some investors rotate into income-generating instruments. Second, and more dangerously, they raise the cost of leverage and compress valuations across multiple asset classes. As bond yields rise, the present value of future cash flows and stocks falls, credit spreads can widen, real estate valuations can adjust. The whole web of asset prices that was supported by low rates has to reset. If this macro reset is already in motion when silver suddenly drops 8%, the move can be interpreted not as an isolated event, but as a symptom of broader deleveraging. Investors start to wonder, is this just silver, or are there other crowded, leveraged trades about to unwind? Are we seeing early signs of a larger dash for cash, where participants sell whatever they can to meet obligations? The phrase liquidity crisis gains power in a context where systemic liquidity, the ease with which the entire financial system can refinance itself, is already under strain. Historical episodes illustrate this dynamic. In 2008, stress began in specific segments of the credit market, subprime mortgages and structured products, but quickly spread to funding markets, then to equities, commodities, and virtually every liquid asset. In March 2020, the initial shock was a public health crisis that triggered a sharp repricing of risk assets. But what turned it into a full-blown liquidity event was the scramble for dollars, as businesses, investors, and governments all simultaneously tried to shore up their cash positions. Even U.S. Treasuries, typically the safest and most liquid market on Earth, experienced dislocations as dealers and investors tried to unload positions to raise cash. In both those episodes, commodities, including silver, saw violent price action, not solely because their own fundamentals changed overnight, but because they were part of a global everything must be liquidated phase. That's the essence of a liquidity crisis. Not merely that prices fall, but that everyone wants liquidity at the same time, and the system's capacity to provide that liquidity is limited. Central banks sit at the center of the system. They control the ultimate form of liquidity, base money, and they influence credit conditions through interest rates, reserve requirements, and asset purchases or sales. When markets are calm, their actions seem distant from day-to-day trading in silver. When a sharp move in silver is accompanied by stress in funding markets, spiking repo rates, widening credit spreads, unusual moves in government bond yields, central bankers take notice. They must decide whether the turbulence is self-correcting or whether it risks feeding on itself in a way that could damage the real economy. If they judge the risk to be systemic, they can deploy various tools, providing emergency funding to banks, opening or expanding repo and swap facilities, slowing or reversing quantitative tightening, even cutting policy rates. These actions inject liquidity into the system, making it easier for leveraged players to roll their funding and for intermediaries to take risk onto their balance sheets. Put simply, central banks can manufacture buyers of last resort, not necessarily for silver itself, but for the funding that underpins all leveraged positions. This is why commentators sometimes jump quickly from a sharp market move to the phrase liquidity crisis, and then almost immediately to speculating about central bank intervention. They're reconnecting the dots along the chain: violent price action, margin stress, funding strain, systemic risk, policy response. The presence or absence of a credible backstop can itself influence behavior. If traders believe that central banks will intervene to prevent a generalized liquidity crisis, they may be more willing to step in and buy distressed assets, stabilizing prices before the crisis metastasizes. But that belief is not guaranteed, especially in an environment where inflation concerns limit central banks' freedom to flood markets with liquidity. If inflation is already elevated and politically sensitive, central banks are more constrained. They may hesitate to cut rates or expand balance sheets aggressively for fear of undermining their inflation-fighting credibility. That tension between financial stability and price stability adds another layer of uncertainty when asset prices start to tumble. So when silver is down 8% and voices declare the liquidity crisis is here, part of the suspense comes from this uncertainty. Are we at the beginning of a 2008-style systemic unwind? A 2020-style sudden stop followed by massive intervention, or a more contained episode of sector-specific deleveraging? To answer that, you need to look beyond price charts and into the unseen flows of funding and collateral. The next part of the story zooms back into the microstructure of markets, the specific mechanics, order books, market makers, ETFs, and algorithms that determine how a wave of selling actually travels through the financial system, and why, in the moment of impact, it can feel like there are no buyers at any price. Now, in the fourth part of this explanation, the focus shifts to how the market's internal wiring can turn selling pressure into abrupt, outsized price moves, making an 8% crash in silver feel like a sudden disappearance of liquidity. Modern markets are a web of electronic order books, algorithmic market makers, high-frequency traders, and large institutional players executing complex strategies. In theory, this ecosystem should enhance liquidity. More participants, more trading venues, more speed. In practice, under stress, the very features that make markets efficient in calm times can amplify instability. Start with the basic order book. At any given moment, there's a stack of bids, buy orders, and offers, sell orders, at different price levels. In a deep, liquid market, this stack is thick. There are many orders at prices close to the last trade. That means a moderate market order to sell will be absorbed without moving the price much. But the perceived liquidity on the screen can be fragile. Many of the quotes you see are from participants who are extremely sensitive to volatility and order flow. When they detect a surge in aggressive selling, their algorithms may automatically widen spreads, reduce order size, or cancel quotes entirely to avoid being run over. Imagine that silver starts the day trading quietly. Then, an unexpected macro headline hits or a large player decides to reduce a big position. A sizable sell order slams into the order book. Prices gap lower as those bids are filled. Other traders' algorithms pick up the move. Volatility is increased, downside momentum is strong, sell-side volume is spiking. Risk models respond by cutting inventory limits or signaling that it is unsafe to hold large opposing positions. As a result, market makers who had been providing buy-side liquidity quickly back away. Their quotes vanish or shrink. From the outside, it feels like the floor just dropped out of the market. In reality, the order book has transformed. Where there were once many small, tight bids, there are now fewer, smaller, wider ones. Each additional sell order must travel farther down the price ladder to find a buyer. That's how a cascade begins. It's not that there are literally no buyers. There are always some buyers at some price, but the price at which meaningful size is available may be several percentage points lower than where the last trade occurred. ETFs, which have made commodities like silver accessible to a broad base of investors, add a further layer. And when investors sell shares of a silver ETF, the ETF's market price may begin to trade at a discount to its net asset value. Authorized participants, specialist firms, step in to arbitrage that gap. They buy the cheap ETF shares and redeem them with the sponsor in exchange for cash or exposure to the underlying metal or futures. To hedge their exposure or complete the arbitrage, they may sell futures or other silver instruments. This process is usually stabilizing, but in a rapid sell-off, it can mean that ETF redemptions and future selling feed into each other, increasing the overall selling pressure. At the same time, large institutions often run systematic strategies that tie together multiple markets. A macro fund might have a model that goes long silver and short another asset when certain relationships hold, and automatically unwinds that trade when correlations break. A risk parity fund might reduce its exposure to all risky assets when volatility rises beyond a threshold. A commodity trading advisor, CTA, might be trend following, programmed to sell more as prices break key levels. On a day when silver drops 8%, many of these models may be triggered at once, all pushing in the same direction. Then there's the role of options and volatility. Dealers who sell options on silver often hedge their exposure dynamically. If they've sold puts, downside protection. To clients, a sharp drop in price can leave them short delta, meaning they lose money if silver falls further. To hedge, they may need to sell futures or the underlying as prices drop, even though that selling itself contributes to the decline. This is another feedback loop. Falling prices increase dealers' need to hedge, which requires selling, which drives prices down further, which increases hedging needs again. All of this happens incredibly fast, often in milliseconds to seconds in the electronic order book, and over minutes to hours in ETF flows and systematic strategies. To the human eye, it appears as a series of violent red candles in air pockets, where the price simply jumps from one level to another with little trading in between. Commentators and traders call it a liquidity vacuum. The more technical description is that the marginal buyer has stepped far away from the current price, and the intermediaries who would usually bridge that gap are constrained by risk limits, capital, or fear. Banks and broker-dealers, historically major sources of market-making capacity, are less able or willing to lean against such flows than they were before the financial crisis. Regulatory changes have pushed them to hold more capital and limit proprietary trading. That has made the system arguably safer from a solvency standpoint, but also more brittle in terms of intraday liquidity. When the storm hits, there are fewer large, well-capitalized players whose job it is to take the other side and warehouse risk until the panic subsides. This is where the notion of a liquidity crisis intersects with microstructure. It's not just that prices move, it assesses that the mechanisms for trading break down in the sense that they no longer provide continuous, thick, two-sided markets. What was a smooth curve of potential prices becomes a jagged, sparsely populated staircase. Each step down represents not just a price concession, but a reflection of who is still willing to come to the table and how much risk they were willing to take. When that breakdown in microstructure occurs at the same time as the funding and macro stresses described earlier, the sense of danger magnifies. A leveraged fund watches silver fall 8%, sees liquidity thin out, and realizes that if it doesn't hit the bids now, it may be forced to do so later at even worse prices under even tighter margin constraints. That fear drives more aggressive selling, which worsens liquidity again. The system can enter a self-reinforcing downward spiral. This spiral doesn't last forever. Eventually, valuations get low enough that some buyers step back in, or policy actions and funding relief stabilize the environment. But at the moment of maximum stress, it truly feels like the trading machinery is failing. That emotional experience, screens bleeding red, quotes vanishing, calls from brokers, is what market participants mean when they say, liquidity has disappeared. It's the visible manifestation of a deeper technical breakdown in the balance between risk, capital, and information. All of this leaves a crucial question hanging over the market after an 8% collapse in silver. Is this merely a violent but contained repricing in a single asset class, or is it a symptom of systemic fragility that could spill into other markets in the real economy? The answer lies in what happens next, both in prices and, more importantly, in the functioning of the funding and trading ecosystem. That brings us to the fifth and final part of this explanation, the possible paths forward after such a crash, what to watch for to distinguish a short-lived shock from a genuine liquidity crisis, and how investors and institutions might think about positioning themselves in a world where episodes like this can erupt with little warning. In this fifth part, imagine the market. In the days and weeks after silver has dropped 8% and headlines scream about a liquidity crisis. The immediate drama of the crash has passed. Prices have either stabilized, continued to slide, or partially rebounded. Now the question is not just what happened, but what it means and what comes next. One possible path is that the event is largely self-contained. After the forced liquidations finish and margin calls are met, the selling pressure abates. New buyers, attracted by lower prices, step in. Market makers gradually tighten spreads again as volatility subsides. Funding markets, while temporarily stressed, continue to function. Short-term interest rates remain orderly. Repo markets are well supplied with cash. In this scenario, the liquidity crisis label was more emotional than technical. It was a sharp liquidity squeeze in a specific asset, painful for those caught on the wrong side, but not a systemic rupture. Another path is more ominous. Here, the silver crash is just the first visible manifestation of deeper cross-asset deleveraging. Funds that took losses in silver also hold leveraged positions in equities, credit, or other commodities. To meet margin calls and reduce overall risk, they begin selling across their portfolios. Correlations rise. Assets that normally move independently start falling together. Credit spreads widen as lenders reassess risk. Signs of stress appear in funding markets. Repo rates spike. Bid-ask spreads in normally liquid instruments like government bonds widen. Commercial paper issuance slows. Central banks and regulators pick up these signals through their monitoring systems and market intelligence. In that darker scenario, the silver crash is a warning shot. It reveals not just fragility in a single market, but the degree to which the financial system has become dependent on continuous, cheap liquidity and benign volatility. The narrative shifts from silver crashed because of X to silver crashed because the system is over-leveraged and under-liquid. That S, when the phrase, the liquidity crisis is here, starts to feel less like hyperbole and more like a diagnosis. Distinguishing between these paths, contained shock versus systemic crisis, requires watching more than just the price of silver. One must look at indicators of funding stress and market functioning. Are key short-term rates behaving normally? Or are there sudden unexplained jumps? Are banks and dealers still willing to extend credit and warehouse inventory? Or are they aggressively shrinking balance sheets? Are corporate and government borrowers still able to roll their debts at reasonable spreads? Are central banks changing their tone, emphasizing financial stability, risks more in speeches and press conferences? If these broader signals remain calm or quickly normalize, the silver event is more likely to be remembered as a sharp but isolated episode. If they deteriorate, it's a sign that the shock is propagating. The suspense in markets after such a crash comes from not knowing, in real time, which path is unfolding. Participants must make decisions under uncertainty. Cut risk now and potentially miss a rebound, or hold on and risk being caught in an escalating crisis. For investors and institutions, episodes like this are a harsh reminder of the distinction between market risk and liquidity risk. Market risk is the possibility that prices move against you. Liquidity risk is the possibility that you cannot exit or adjust positions without taking far larger losses than you anticipated, or that you cannot roll your funding when you need to. An 8% one-day move in silver that is exacerbated by liquidity shortages illustrates how quickly liquidity risk can materialize and how it can compound ordinary market risk. Managing that risk is less about predicting specific crashes and more about respecting the structure of leverage, collateral, and funding that underpins every position. It means understanding how much of your exposure is financed with short-term borrowing, how quickly margin terms can change, and how correlated your positions might become under stress. It means recognizing that in a genuine liquidity crisis, correlations tend to go to 1. Not because fundamentals suddenly align, but because everyone is trying to raise cash at the same time. It also invites a more nuanced view of assets like silver. Some investors treat silver purely as a hedge or safe haven, assuming it will rise when financial stress increases. But as history has shown, in the very early stages of a crisis, even hedge assets can be sold off if they've been used as collateral or held in leveraged form. The sequence can be paradoxical. Stress rises, silver falls sharply as leveraged holders are forced to sell. Then later, once deleveraging has run its course and policy responses kick in, silver and other hard assets may begin to rally as investors seek protection from the longer-term consequences of those responses, such as renewed monetary easing or currency debasement. Behind every price chart is a network of balance sheets, credit lines, margin agreements, and risk models. When you see it crashed, silver drops. 8%. The liquidity crisis is here, splashed across the screen. The story is not just about a metal or even just about speculators. It's about that entire network tightening and shifting under stress. The hook is the violence of the move. The fact is the mechanical, structural nature of the cascade. The suspense is whether the tightening stops with a few broken trades and bruised egos, or continues until something vital in the financial system snaps. Ultimately, episodes like this underscore a simple but uncomfortable reality. Modern markets are engineered for efficiency in normal times, but that same engineering can make them fragile in extremes. High leverage, tight spreads, and abundant liquidity are pleasant companions when the sun is shining. When the storm hits, when a major asset drops 8% in a day and liquidity visibly evaporates, those features transform. They reveal how dependent stability has become on continuous confidence and uninterrupted funding. Whether the liquidity crisis is truly here or merely glimpsed in a single violent break depends on how that confidence and funding evolve after the shock. Silver's crash is a signal. What it ultimately foretells can only be known as the rest of the system responds, adapts, or, in the worst case, fails to do so in time.